it still safe to invest in the Chinese stock market? Or should I buy more now that the prices are lower? But is it too risky? I think these are some of the biggest questions running in your minds right now. So in today's Moneyball Journal sharing, let me share with you guys on my views on this. What exactly is happening in China? The most famous regulatory crackdown we should all be very familiar with was the Alibaba saga. And there have been some kind of a closure to that saga for Alibaba, as a heavy fine of US 2.8 billion has been imposed. And Alibaba has also interestingly responded with gratitude for the regulatory outcome. And when we thought that all was fine with the Chinese stock market, then came further regulatory crackdowns. We saw Tencent coming under the regulatory pressure, Didi, the newly IPO'd ride-hailing company, being forced to delist, Meituan with new worker protection rules, and also the private educational companies forced to convert into non-profit organizations. If you have always been investing in the US market or the local market, I think all this news have definitely shocked you and induced some kind of resistance against investing in the Chinese market. To top it up, mainstream media and strategists at Goldman Sachs have described the Chinese stock market as uninvestable. For us to understand why all this are happening, we have to first understand that China runs a state capitalist system, which means to say that China has to look after the interests of the majority. Time after time, China likes to teach the rich capitalists a lesson if they stand in the way for the better good of the society and the country. So how do I view this whole regulatory crackdown and the impact on the stock market? In investing, we need to first assess the risk, then the risk to reward. Yes, the risk comes first, not the returns. Most investors are too fixated on the returns, and it has become habitual that they don't realize they are only looking at the returns while forgetting all about the risk. So to assess our risk in this situation, we need to ask ourselves the following questions. Will the Chinese companies being cracked down underperform its major competitors in the industry it is in? Or will the profits be negatively impacted? Have the fundamentals and the quality of the companies changed? First, let's address the private educational companies industry. The level of regulatory changes in the private education market is massive. The existing for-profit companies are banned and have to be registered as non-profit organizations. No more holiday and weekend tuition. And for entrepreneurs thinking of establishing a new tuition center, the State Council has said that there will be no more approval of new tuition centers. That's because the situation for private education has been bad in China. Parents are throwing in lots of money for their kids to get into those classes. The kids are also facing immense stress and competition. There is even an app by Yuan Fudao that uses AI, so parents use that app for checking the homework of their kids. Are the profits going to be negatively impacted? Yes, massively impacted by the new regulations. This is not a case of just cracking down on only one or two major companies. The entire private education industry is being regulated and cracked down. I'm staying away from these educational companies, and in fact, they are not in my watch list in the first place. Okay, so what about the big tech giants like Alibaba and Tencent? Beijing views the tech and tutoring sector differently. As the crackdown is happening at about the same time, it is understandable for investors to lump both of them together. The Chinese regulatory moves, in this case in the tech industry, they were not intended to turn all these companies unprofitable. There's so much foreign money going in. It benefits the Chinese economy for these giant tech companies to expand overseas. The purpose of the regulation was to level out the playing field for the smaller players and to crack down on the unfair practices of those tech giants that are impeding the growth of the smaller players. It is still very much in Beijing's interest for its tech firms to do well, as if otherwise the beneficiaries could be the American tech giants. We have shared in our previous portfolio updates that we do hold positions in these Chinese tech giants. Our opinion is that they will still continue to dominate given their first mover advantage. Though any new restrictions on data collection issues will keep them in check and their growth trajectory will be impacted to some extent. We are still of the view that the fundamentals of these quality companies have been largely unchanged. So instead of panic selling, we have been accumulating positions for some of these tech giants during this recent sell-off. If today I'm not yet invested, this would be a good opportunity that I will take up to add some positions. If I'm already invested and still have some cash at the sidelines, I will then accumulate positions to average down my cost. Having said that, my Moneyball portfolio construction strategy is never to put all the eggs in one basket. Hence, if I already have a sizable concentration of Chinese stocks in my portfolio, I'll have to give this opportunity a miss. Alternatively, if you do not wish to be overexposed to a single company, you can consider buying ETFs such as KWEB, which gives exposure to the overall Chinese tech. The China market, if you were to compare against the US market, has been historically more volatile. That is due to the greater proportion of retail investors in the China market compared to the US market. For those who are not familiar with the Chinese market, this is something you may want to take note of to prepare yourself emotionally, because it is easy to fall prey to your emotional struggles when you see your portfolio in the red. Or when you read articles like ARK Invest, Cathy Wood dumps more Chinese stocks amid crackdown. In fact, some recent studies may show that China could overtake the US as the world's largest economy earlier than expected because of COVID-19. The latest GDP reports show that the US fell by 2.3% in 2020, while China grew by 2.3% amid the coronavirus pandemic. The divergence means that China will likely overtake the US as the world's largest economy a few years earlier than expected, as economists said. I believe there are opportunities and risks in both the US and the China market as they compete with each other. They are both important players, so this is why I construct my portfolio with both US and China stocks. As investors, we want to capitalize on good opportunities so that we can ride on them. It is, however, unfortunate that in this instance, the Chinese government did not publicly communicate the reasoning behind their actions. Hence, we should not construe such acts as reversal of major trends that have existed for the past decades. That said, we must also understand that the Chinese companies are much more subjected to political control compared to the United States or other parts of the world. But as long as the China big tech companies are willing to get with the nation's program, it is in China's interest for them to flourish. I believe the end goal for China is to overtake the US. So the tech crackdown is to help China gain control over big data, which is a strategic asset for China's competition against the US. Thank you for watching this video. See you in our next Moneyball Journal sharing.